Hi everyone, and welcome for this call today. We're having this call after a quite a long time. I believe we discussed about Greater China region somewhere in the month of April and May with our special guest, Alexander Treves. And we have many questions for him today, and I'm sure a lot of you would be having a lot of questions around what's happening in Greater China, what's happening in the underlying fund which you and your investors would have invested. So welcome, Alex, and we look forward to have a very exciting and informative session along with you. We've been, speaking to our partners and investors, and a lot of partners and investors are particularly worried about their investments in, Greater China fund over the last 1-2 years. The reason is if you go back to 2020 or 2021, Greater China was one of the region which was shining across the globe because all other countries were underperforming and Greater China region was doing really, really well. However, we have seen over the last 1.5 year particularly, the fund has been underperforming and the entire region has been underperforming. So let us start with the moot question which everyone has is what are the factors which have contributed to the underperformance of the Greater China region over the last 1.5 years?
Perfect. Thank you very much. Well, thank you for hosting me, and I'd like to thank everyone who has taken the time to dial in this afternoon. It's hugely appreciated. So let's go back a couple of years and just remind ourselves what China has been through. So if we go on to the first slide, please. The thing to remember about COVID is that COVID had a very unusual couple of circumstances. Now, we had an economic and humanitarian catastrophe, which was accompanied by a technology bull market, which is very, very unusual in my experience. And the reason that happened, of course, is that COVID, unlike anything I've experienced before, was an economic emergency, a health and economic emergency, which forced everyone to change their behavior such that they went and they spent their entire lives at home. They worked from home, they got their educations at home online, they entertained themselves from home, they did their shopping at home, they ordered food. And so somehow our move from the old economy to the new economy was accelerated by the particular circumstances of the pandemic. Now, what that meant is that the big tech companies, which are a major part of the Chinese indices, got a huge boost. And these are obviously the e-commerce companies and the online food delivery stocks, because the entire Chinese population then had to do their shopping online. This is gaming and social media. This is also, of course, the hardware, maybe more in Taiwan than in China, which sits behind all of that online activity. And this took place in the context of actually quite a loose regulatory environment. So those were good times, not in personal terms, but in terms of what was happening in the market. What happened then last year was that we saw the pendulum swinging back in the opposite direction. So we saw around the world the beginning of a sort of a normalization of the COVID situation, although I will talk more about the mainland Chinese situation in due course. And we also saw in China then a sort of a reaction from the regulators that maybe they had been too lax in 2019, 2020, so 2020 through the pandemic, and they needed to pay a bit more attention to what the internet companies were doing. And that's basically the story of this slide here, which is that 2020 saw stimulus, it saw loose regulation, there are some unintended consequences of that, and then 2021, the government responded. Now, what did they do? One thing they did is they said, well, we're going to have a slower economy in the future, but we want it to be a more balanced economy. So we are going to try to control more of the debt in the system, a lot of which sits in the real estate market. So that was then a drag on growth. They also said some of these internet companies actually are misbehaving, if we're honest. And they enacted a bunch of measures which, from the outside, seemed quite heavy-handed, but I would argue are more reasonable than many people give them credit for. So there were measures around combating monopolistic behavior, or pushing back on regulatory arbitrage, or forcing delivery companies to treat their workers better, etc. Now, a lot of these measures had already taken place in the West. So China wasn't doing anything egregious a lot of the time. It was just catching up, and it wasn't communicating those changes as sensitively as it might have. And this is very much the nature of the beast. We need to understand this, that China is a heavily regulated, centrally planned economy, and they're not always going to be as diplomatic around these sorts of changes as you would hope. But that doesn't mean the changes themselves were all preposterous by any stretch of the imagination. So the combination then of the slowing economy, given what's happening in the real estate market, the pressure put on the big internet companies, etc., that caused a change in market direction last year. And then this year we've had something else as well, of course. So if we go to the next slide, please. The other key change this year was the implications of zero COVID. And this has become a sort of a matter of political orthodoxy. And it's not, you and I could have a conversation around whether COVID zero makes sense or is possible, but that's not really the point. The point is that the government has prioritized saving any number of lives over the sort of the freedoms which we're experiencing in some other parts of the world from COVID lockdowns. And in a year which is politically very sensitive for Xi Jinping, and this is a sensitive month, they don't want to back down on that. And so COVID zero has become absolute. And what that means, of course, is it's been quite negative for certain areas of the economy, because, for example, if you're locked in your compound, you can't go shopping. The travel industry has suffered. And we've had these sort of rolling lockdowns, which we think are easing, but have nevertheless been a headwind for growth. And then the other thing which has progressed this year over last year, if we go on to the next slide, please, has just been the ongoing sort of squeeze on balance sheets in the real estate market. And I think we should acknowledge that combating excess leverage in real estate is not a stupid thing to do at all. And China wants to move away from this boom and bust cycle which characterized a lot of its growth path over the last generation. But there will be collateral damage along the way. And our conclusion here is this is a growth headwind, as is zero COVID. There will be some losers, most notably low quality companies who don't have sustainable business models, but that's okay, that's how capitalism works. But this will not be systemic. So it's a challenge, but it's not a systemic challenge. Now, just to sort of wrap up my answer to your first question, I also think it's important for all of us to be very honest with ourselves about what China is. China is, and I don't ever use this in the pejorative sense, but China is an emerging market. It's a volatile asset class. It is a centrally planned economy, so the government's got a significant role in the way that the market operates, but it's also got a very dynamic corporate sector. So the fact that we're seeing a pullback this year after a stronger period of time, it's uncomfortable, but in the context of the longer run picture and of a volatile asset class, it's not utterly surprising.
Thanks, Alex. So while we have seen what has actually happened and why the underperformance is, what, according to you, could change this, and what could be the trigger which will help China market, or rather, revive the China equity market? Let me put it that way, over the next, couple of quarters. So what could be the real triggers?
Well, let me be utterly honest. I always try to be utterly honest, but let me be utterly honest. I don't believe in triggers necessarily for investing. The reason being that by the time a catalyst is obvious to us, it's out in the market. So I think it's very hard to invest around individual catalysts. You try and be clever about timing a catalyst and you probably miss the bigger picture. But one thing we can say, which is on the next slide, please, is that there is something very interesting and counter-cyclical happening in China, and we've got strong conviction that this will persist. Now, let's go back a step, which is, as I've said, zero COVID is a thing. I don't think it'll change in the next week or the next month. So that is an impediment to growth on the supply side and on the demand side. It's harder to make things and it's harder to buy things. That's a fact. But there is something else which is also a thing, which is that the government clearly still cares about economic growth in China. Now, they will accept a lower growth rate in the future than in the past, and that's because the middle class is that much wealthier now. The whole population is that much wealthier, so they don't need to keep growing at 9% a year. But nevertheless, economic growth is important for the ongoing power base of the government there. And if we start with zero COVID and we end with the notion that growth is still important, well, there's only one route between those two sort of points, and that is monetary easing, it's fiscal stimulus, and it's a pullback in some of the regulations that we've seen over the last year or so. And I think it's always very important to be clear about where you have confidence, and we've got a lot of confidence that, unlike almost any other central bank on the planet, with I think the exception of the Turkish central bank, which possibly isn't the exemplar for central banks, this is the only central bank which is easing while the Fed is raising rates, while the RBI is raising rates, while the BOE is raising rates, while the ECB is raising rates, etc. And the BOJ is just flat, but that's different. And then we've got fiscal stimulus, which maybe we'll talk a bit more about in a moment. And then I've already spoken about the regulatory pendulum. Please remember, China is a heavily regulated economy. It was regulated in 2018. It's the last round of tightening, and it'll be regulated again in the future. But for the moment, we think the regulators are pulling back to stimulate growth. So I think that in the context of a diversified global portfolio, this is quite interesting because the Chinese government is behaving in a different way than almost any other government I can think of.
Right. So, as we understood, the regulation, the pace of regulation is maybe well behind, and the near term looks, a bit stable. What would really drive the equity markets is the medium and the long-term outlook on the economy. So what do you think is the medium to long-term outlook for the China market, and how is it set up according to you and your portfolio managers and their views?
Well, first I just have to endorse 100% about what you said, which is you have to take a long-term view. Because if someone says to me, what's going to happen in China next month, I don't know. None of us knows. We don't know. You can't form a portfolio around that. On the other hand, if someone says to me, do I think that the Chinese economy will be bigger in 10 years' time than it is now? I believe that. I sincerely believe that. Do I think that the corporate sector will be taking a share of that revenue in terms of earnings? Well, yes, I do. And do I think that the corporate sector in China will remain sort of vibrant and it'll carry on developing? Well, yes, I believe that as well. So that to me sort of helps me anchor my longer run expectations. In 6 months, I don't know. I don't know. Let's be totally clear about that. But on a 5-year view, sure, I think this will be a more valuable asset class. So how do we get from here to there? Well, let's go on to the next slide, please, because this is quite important. And this is around saying that quite a lot is in the price already. And we've talked a little bit about the story of what's going on in China. But what we should always do is just stop and say, well, how much are we being asked to pay for this story? Very few people go to the tailor and choose a suit without checking the price tag. If I go to the supermarket before I buy my groceries, I tend to check what things cost, and the same is true in the stock market. So we know what the story is, but how much are we being asked to pay for it? And this is the first measure of that, which is the aggregate price to book ratio for Chinese equities. And this is from this summer. And what you can see is that in aggregate, price to book is now down towards the lower end of the range. Now, it could go lower for sure, but it certainly isn't expensive. So some of this bad news that we've been talking about, that's already in the price, that's happened. But let's go on to the next slide, because I think this is more important still. Because the price to book is a sort of a consensus estimate. But what we have here is we have our own internal expected return signal. And what we do for every stock that we cover, and we cover around 600 stocks in the Greater China region, is we forecast the earnings over the next 5 years. We have an exit multiple, so that tells us what the valuation will do. We look at dividends, which frankly aren't a huge driver for this portfolio as they would not be for an Indian portfolio. And we look at FX to normalize everything into US dollar terms. And the point of this is that unlike the price to book chart where low is exciting, on this page, high is exciting, because the higher the blue line, the higher our expected return across all of the stocks that we cover looking forward for 5 years. And so what you can see here is that the 5-year expected return that we see is way off the lows. In other words, we see a higher return in the future than we would have a couple of years ago. And I want to emphasize this because we have our own internal research resource. This is very important to us. We don't want to use other people's research to invest in Chinese equities. We have 16 dedicated Greater China analysts, all of whom speak Mandarin, all of whom sit in the region doing this work. And this is the outcome of their analysis. And that's very important to us. And now let's spend a moment just on the next slide, please, because coming back to your question in terms of how we are positioned, well, you can see that the PE of our portfolio is higher than the market, so it's a bit more expensive. But that's because when we go down the page, the return on equity is higher, which is to say that we've got a quality portfolio compared to the broader market. So we're looking for stocks which have got higher returns, which I think is important in any time of economic pressure. And importantly below that, so the bottom of those red rectangles, you can see our 5-year expected growth rate for our portfolio is meaningfully higher than for the benchmark or the broader market. So I think the point there is that we still find attractive earnings growth from this asset class. And we still think we can find companies which have got an attractive return on equity as well. So growth and quality. And that's at the core of our portfolio.
Thanks. So if I were to sum it up, Alex, and just add if I'm missing any point, is if what we have seen is over the last 1 year, a pace of regulations which came in, plus the zero COVID policy of China, which has hurted a bit to its economic growth. However, things are looking stable right now. And when you're investing in equity, of course, the medium to long-term view is very, very important, and which today looks very good because the earnings growth is, reasonably strong. What is more important is the valuations in Chinese market is today probably one of the cheapest what we have seen over the last decade or so, which is why, for investors, according to your analysis, the expected returns over the next 5 years are pretty attractive. However, investors should not forget that Chinese market is a volatile market. There would be risk. What will happen over the next 6 months or a year? We don't know. So one should brace themselves for volatility if there is any untoward news over this period. This sums up very well what's happening and what to expect. Now, I want you to answer.
Sorry, sir. Before you ask the next question, though, look,
please.
That was a very good summary.
Yeah.
And I want to emphasize one point, which is that if, as an investor, you don't like volatility,
right,
this is not the asset class for you.
Right.
So, and the reason I say that is because I don't want people to think that I will sell this willy-nilly to everyone to try and get a bigger bonus at the end of the year. I've got no interest in that. If you don't like volatility, this is the wrong asset class. So let's be clear about that. And there's horses for courses. The other thing, the only thing I would take issue with, and I want to again just get this out there in the spirit of transparency, is there was one word in your eloquent summary which I disagree with, which is the word stable. Because I think it's a stretch to say the world is in a stable place.
Right.
We have conflict, sadly, in Eastern Europe. We've got inflation, which is much higher than many of us remember. We've got central banks reacting accordingly. And we do have within China the tail end, I think, of the COVID situation. I mean, I do believe strongly that in 3 years' time, we're not going to be talking about this, but in 3 months' time, we still will be, I suspect. Yes. But that's okay, because if you wait for stability, you will have missed the investment opportunity, for sure. Now, I don't know if this is the right time, but if you wait until everything is calm, you'll have missed the boat. So I don't think the world is stable, but I can live with that because I'm an emerging market investor. This is the environment we operate in.
Absolutely, Alex. Thanks for pointing out, and really appreciate that. Now, coming to the fund and how the portfolio is positioned over the last few months, I just want to take this forward by asking you how the portfolio manager is navigating this environment. Have there been any change in the key themes which the fund was overweight or banking on over the last 1 year or so?
Okay, no, thank you for the question. And let's go to the next slide, please, because this explains just our philosophy within the portfolio. And this does not change. Well, if ever you come across a growth manager who suddenly becomes a value manager because the markets are turning down, you must run a mile from these people, because what you want is consistency so that you know that you are getting what it says on the tin. So what do we believe? Well, the first thing is that in China, as in India, we think that this is a longer-term growth story. And we think that a lot of our investors want to invest in China because they want to experience that growth. So we're growth investors in China. The next thing to say, however, is if your measure of growth is just companies which are growing quickly, you can get some really interesting business opportunities, and you can get some shockingly bad companies as well. And I don't want to repeat that again, but I'll say it one more time. China is an emerging market. There's a broad spectrum of opportunities there. So we don't just go for any growth, we want quality and growth. And I think that with a fiduciary mindset, quality is incredibly important. Doing our best to look after our clients, our clients' interests. The next thing to say is that we don't think that the index is a very good way to invest in Chinese equities. And we say that because it's an inefficient asset class, because it does contain an awful lot which is unattractive as well as which is attractive. And so we don't want our portfolio to look like the index. We want it to look different than the index because we think that over time we will outperform that index. So growth, quality, and selectivity. And then we do that by being very fundamental, very bottom up, very oriented around individual stocks. So we can have a conversation about what the GDP number might be. Whatever it says, it probably won't even be it won't even be an accurate number. That's okay. If you find the right companies with the right business models, the right management team, the right execution of the right strategy, which will grow earnings over time, those businesses will sort of succeed irrespective of whatever that quarter's GDP print is. So that hasn't changed at all. And then on the next slide, please, if we just look at the underlying themes we want to represent in the portfolio, again, those are quite consistent. Now, in a moment, we will talk about some of the tweaks that we've done. But again, if you want to invest in quality and growth in Greater China, you don't buy the big state-owned banks. You don't buy the energy companies. You don't buy the telecom companies, because these are all either capital intensive and low growth or subject to national service. They don't have that same entrepreneurial spirit, that we're looking for. So what we do look for is technology, for example, because we know that both individual consumers and also corporates in China are going to consume more technology. And more importantly than that, there is a growing cohort of Chinese companies which can supply that technology. So it's all well and good that people want to buy this stuff, but the way that we monetize it is by owning the companies which sell it to them. And this is in hardware, such as semiconductors, which we can talk about. And it's in other areas like software or industrial, factory automation, etc. So the broader technology space. Then we've got carbon neutrality. A couple of times on this call, I've talked about the fact that China will accept a lower economic growth rate in return for a more stable growth rate. And I've talked about that stability in terms of the aggregate balance sheet in the real estate sector. But another area of economic stability is in the environmental sense. And so we've got strong conviction that China will carry on improving its environmental footprint. And if you think back to my comments about monetary, fiscal, and regulatory stimulus on the fiscal part, one clear area one lever, maybe I should say, that the government can pull is for more solar power, more smart grid, an ongoing upgrade of that side of things. So that's an area they can spend money profitably to boost the economy at the same time as furthering their environmental aims. And then, of course, in China, as in India, you've got this growing middle class, people with more money in their wallet to spend on things. And so we've got the consumption space, and that can be quite sort of prosaic consumption, so quite average things like soy sauce, pickles, and things like that, or it can be consumption of much more exciting areas such as healthcare, goods and services. And that's pretty consistent, but maybe you'll ask me about something a bit more tactical.
Just extending this to more granular details, Alex, can you just run us through what have been the specific changes in the portfolio, if any, over the last few months in terms of stocks and some of these picks in each of these themes which we have in the portfolio currently?
Well, I'll be happy to do that, and I think it'll also give a nice illustration of some of the sorts of things that we're investing in. So let's go to the next slide, please. And if you ever want to know what a portfolio manager is thinking about the future, the best way to do it is just look at their current portfolio positioning, because that's how they express it. So you can see that, and let's just focus on the top half of this page here, which is the sector breakdown through the portfolio. So starting on the left, you can see that the biggest absolute and relative position is in information technology. So that's very consistent over time. And I've talked about the structural opportunity. There's also maybe a more near-term opportunity, which is the whole notion of import substitution. And just to take a step back and talk about what I mean by that, I guarantee you that I will get questions about geopolitical tension between the US and China. And I will tell you about them in due course. But there are unintended consequences of everything that governments do. And one of the unintended consequences of the geopolitical tension is that China is insistent on becoming self-sufficient in areas where previously it relied on imports. Now, they can only do that because they have rapidly moved up the R&D chain or the value-added chain. But 10 years ago, if China wanted to buy semiconductors, they had to go overseas. If they want to buy the best semiconductors, they still have to go overseas. But if they want to buy commoditized semiconductors, they can now make them themselves. So that's one example of the sort of thing that we like in IT. And the harder that the US pushes China, the faster China will wish to become self-sufficient in a wide variety of IT areas. And that extends to software as well. And then at the other end of the spectrum, another consistent piece of positioning is to be underweight areas like energy and financials. And let me spend a moment on financials, because I'm always very aware when I'm speaking to an Indian audience that this is one of the key points of difference between the Indian market and the Chinese market. Now, some of the similarities exist in areas such as consumption. Big country, lots of people getting wealthier. But one of the key differences is that India has got this fantastic, large selection of private sector financials, which have really just been standard bearers for the industry regionally, globally. And they are dominated by private sector firms. Whereas in China, the model is different. In China, which is still it's a single party country, the banking sector is dominated still by the state-owned financials. And we think that as minority equity investors, we are not at the top of their list of stakeholders. They are much more prone to risk of national service. Their returns are lower, their growth rates are lower. And so that's an area that we're consistently underweight. And then in the middle, if I look at a good example of a couple of changes we've made, well, we've been reducing some consumer discretionary stocks this year. And that's more of I don't want to say that we're traders, but that's more of a tactical move, because although we believe in the consumption story, we also know that it's quite hard for people to consume as much when there are lockdowns. And also, so there's a sort of a less robust revenue environment. The top line growth is less strong than it might be. And at the same time, of course, you've got this global inflation issue, which is squeezing margins. So we've got a bigger active position in staples than in discretionary, because staples are less at risk of that margin pressure. They've got a more stable revenue stream. And so they are probably a safer place to be at a time of uncertainty. And then one other thing I'll point out is real estate. And given what I've said about real estate, you might be surprised to see that we've got an overweight there. But recall what I said is we don't think it's systemic. We think that bad developers will go out of business, but we go out of our way not to buy bad developers. We think that some of the better companies will be able to consolidate market share into this difficult environment. And also, actually, a lot of our real estate exposure comes not through developers, but through real estate services, which is much more of a consumer play. So people who will manage your apartment complex or your condominium complex, the security and the landscaping and the concierge service, all the disinfectant and the cleaning and all those things. And so that is an area that we added to earlier this year. Because even while the news was bad, the valuations we thought had factored that in. So those are some of the changes. Now on the next slide, I'll go into a bit more detail briefly. So here are some of the trades we did in the second quarter. And I think what will I point out? I will point out that we've moved a bit of money within financials. So from Ping An Insurance, which is an insurance company, into Ping An Bank. And Ping An Insurance had a number of missteps that meant we'd lost some conviction there. For this portfolio, we sold CATL altogether. Now CATL is Contemporary Amperex, which is the leading battery supplier for electric vehicles in China. And they were seeing some cost pressure, some margin pressure, or some earnings pressure there. And we've moved money into other areas. And I think the standouts will be something like Nari Technology, which is a smart grid operator, or a company which helps make the state grid for transmission and distribution more effective. And so thinking back to what I said about fiscal stimulus, this is a good example of a beneficiary of that. And then we added to Meituan, JD, and Tencent. Now, these are three of the internet giants. And we started this conversation by talking about regulation. And the fact is these businesses will persist. The business models are still strong and robust. We don't like every stock in the space equally, but we think that these were offering good value. We think they'll carry on growing. We think that the government is not anti-innovation. And so we've been adding to this area. Even as there's maybe some bad news out there and people are worried about it, that's when you get something at a more of a bargain price. So that's an area we've been adding.
Thanks, Alex. What we'll do is we'll take a couple of questions from the audience, and then maybe towards the end we will summarize what we've discussed so far. One very important question which we keep getting is, and we've got a couple of them from many of our participants today, is there are three worries which people have with China. One, there is a whole lot of businesses moving out of China. So because people know that China's GDP was largely dependent on exports, which I'm sure it's not now, but a lot of businesses are moving out of China, and what will happen to that export-driven GDP growth which China was clocking. The second worry is about the entire real estate slowdown which is happening in China, because a large part of China's GDP is contributed by real estate. And the third worry, which is around the elections. As you mentioned, it's a single party country, and even I know that election doesn't matter much in China, but there are a lot of news around that there could be some things around in elections going on in China. So these are the three major worries which we keep hearing from our investors and partners. And if you could just throw light and your views on these three.
Okay, so I think the first thing to say is don't be fixated on the level of economic growth. Because for a long time, China had high economic growth, much higher than it is now, but it was a terrible place to invest because, remember, it's a new stock market. When I started in this job in Singapore in 1996, you couldn't invest in Chinese companies because they weren't listed yet. And then the first companies which were listed were typically very large state-owned enterprises. And the model, if we're honest, was to raise money from Westerners who had this dream about China and to use it to fund infrastructure build out for Chinese people. So, and I lived in Bombay for 3 years, so I say this meaning no disrespect, but if you look at what China has done with its infrastructure in the last 20 years, it's India can only dream about that sort of pace of development. But that didn't mean that as an overseas equity investor, you made money along the way. The equity market in India was much more exciting. So China built the roads and the bridges. India had the private sector banks to be excited about in your portfolio. So don't fixate only on the economy, not only on it. Now, as for the export piece then, the vast majority of our portfolio is exposed to the domestic market. A lot of the exporters, and this is excluding Taiwan technology, which of course is not in the mainland, but if we think about the exporters within the mainland, a lot of them are characterized by mass market, lower margin, more commoditized, and that's not really how we think people should be investing. You want companies with good intellectual property, you want high barriers to entry, you want them to be able to monetize their ideas rather than just make sports shoes for the masses. So already we're domestically oriented. As for the export piece, if that is what worries you, well, yes, some businesses are moving offshore, but it's at the margin. It's at the margin. And Vietnam, of course, is one of the beneficiaries of this, but the Vietnamese economy is, well, its population is less than 10% of the Chinese population. Its economy will be a percentage of that. So there is no way on earth that the entire manufacturing infrastructure in the Pearl River Delta and the Yangtze River Delta will somehow uproot itself and move to Vietnam. It's simply not possible. It'll happen at the margin, but Vietnam will feel the benefit much more rapidly than China will feel the loss because of the relative size of the two. And remember also, you shouldn't assume that the companies which are taking things out of the mainland and making them elsewhere are all Western companies. I mean, there's a stock called Luxshare Precision, and they are an Apple supply chain company. And they've got factories, actually not just in Vietnam, but they've also got a plant in India. So they can monetize it wherever the manufacturing is taking place. So we focus much more on the domestic economy than on whatever the export play is. And by the way, here's a fun fact. I'm a big fan of fun facts. The average manufacturing wage in Malaysia is now lower than in China. So it's already not a cheap place to do stuff in those terms, but that's okay. It will persist. We're looking at the money that the laborers are spending, not necessarily on them being the cheapest place to do anything. First thing. Okay, second thing, real estate. Well, I think, as I say, the punchline is we think it's not systemic. If there is a line the government doesn't want to cross, it's that people who put down deposits must not lose the apartments they paid for upfront. And so we think that all of those units will be completed, and then there might be an air pocket when new units don't start getting developed. But we think there are plenty of opportunities to invest in other industries which aren't directly impacted by this. So if there was a systemic risk, I'd be much more worried, but we think there isn't. So we think it'll have an issue for growth. But we think there are other areas such as the stocks on the left hand and the second from right column here, which will still be fine. And if you think about, so Meituan, which is a food delivery company, their business just isn't affected by the property market. So we think it's independent. And then you use the word elections for the third question. I'm not sure election is quite the right word, but we'll stick with that for the moment. So if you're talking about the NPC, the National Party Congress, we think it is politically significant, but not significant in stock market terms. It's not a stock market meeting. It's not an economic meeting. It's around the party. And I was chatting to one of our PMs earlier today, and her view is that for the investor terms, it's more or less a non-issue.
Thanks, Alex. Couple of more questions. One question is, now, what would you put as top 3 concerns about the Greater China, or specifically the maybe in 3 years and 5 years? What
your major concerns about the Greater China portfolio over the next how long?
Over the next 3 or 5 years, which is medium to long term. What, according to you, could be the 3 major potential risks which can come for the Chinese equity markets?
Well, I mean, I suppose the first thing to say, which is obvious, which is I've said don't worry too much about the economy, but if we do get a period of global stagflation, I think that will just be difficult for all of us, and it would impact revenues, it'll impact input costs, so it'll affect margins, and also I think it would affect risk assets as well. People will just be less willing to accept risk in portfolios if that's what we go through. So I think there's the big global thing. but that's realistically not within China's control. It's a part of it, but it doesn't control that. And actually, China is probably better positioned than many other places for the reasons I mentioned. Inflation is not an issue in China. Demand is the issue in China, given some of the measures they've got. So I think that would be one of them. I think another one is just, I've already said that I think that China is not anti-innovation. And the reason I think that is quite simple, which is that China wants to be a superpower if it isn't already. And it is, but it wants to be even more of a superpower. And if we go back many years, the first big step that China went from being quite isolated to being a superpower is that they became the workshop of the world. They joined the WTO and made everything for everyone in a way that India hasn't yet. That only gets you so far. And they know very well that they're not going to get from this level of wealth to the next level of wealth, or this level of geopolitical importance to the next level by carrying on just making stuff for us. They need to innovate. They want to be cutting edge. And so I think that they will carry on giving some latitude towards their tech industry because they know that's the route to success. However, there are periods where, as I say, the regulator can be quite heavy-handed. There are domestic concerns which will sometimes overrule the sort of concerns that we might have as foreign equity investors. And I hope that they just let the entrepreneurial side of things flourish, because that's what's so precious. And I'd make exactly the same comment about the Indian market. It's the entrepreneurial pieces we want to invest in, and they're given quite free rein in India, and we need to, I would be very concerned if that ceased to be the case in China. And as for the third risk, I'm trying to think of something that we haven't addressed already. I mean, if the real estate market, if it became a systemic issue, which we don't think is the case, if markets derated further, but I think we've kind of talked about that. I'm sure there will be questions around, maybe implicit in that is how worried am I about geopolitics? And the answer is that I think that generally you can't invest on the basis of geopolitics. They generate large numbers of headlines for journalists, which is what journalists love to do, but they typically wash over quite quickly in terms of the impact on the real world. What's going on in Eastern Europe is a notable exception to that, but we don't see that being a template for this part of the world. And so I think actually that most of the geopolitics will be actually dominated just by America and China pushing back at one another, creating quite a lot of noise, creating issues for some companies, but creating opportunities for other companies. And I won't repeat what I said about import self-sufficiency, but that's how we think about that for the moment. But if I was wrong on that, then that would be a risk.
Thanks. So, one of the questions, and I'm getting a lot of questions around the macroeconomic trends which are there in Chinese economy and the Greater China region. People often have tried to while investing, try to look at the very near term picture and forget about the longer trends which are taking shape in any economy. And I'm sure even in China, a lot of things are changing. And one of the points which you mentioned is a large middle class population which will be getting added to the Chinese economy, which will help consumption. Also, there is a lot in terms of rapid urbanization, which will still happen in Chinese economy or in other Chinese region. So what are such 3-4 very important macroeconomic shifts which you are seeing within the Chinese economy over the next few years, which will help China's equity perform relatively well compared to other regions?
Okay, well, so I think it all boils down to earnings, doesn't it?
Right.
That's how equity markets work. Is if earnings grow over time in the equities that you own, then those equities will become more valuable in the future than they were in the past, and that's how we make money. So then the question is, well, how do companies generate earnings? I know that sounds like a bizarrely a stupidly simple question, but companies make earnings by selling things to other people making a margin out of that, generating profit. If you put your earnings over your balance sheet, you get your return on equity, and that may or may not be attractive to us. Now, if I ask you to cast your mind back, well, you're not as old as me, but if I ask you to cast your mind back 15, 20 years and say, what was China known for? What did you own which was made in China 20 years ago? And my guess is nothing, actually. Maybe some shoes, maybe. Probably not clothes, because India's got a big garment industry. None of your consumer electronics are made in China. And although the iPhone wasn't a thing, nothing which was high-tech was made in China at all. Now what do you own which is made in China? Well, when I lived in Mumbai or Bombay, my fridge was made in China. That was a first for me. It worked, kept my beer cold. I was happy with that. And now, if I think about my Apple device sitting in my pocket, a large number of the components for that are made in China. So this is a country which has gone from making maybe your sports shoes to maybe your refrigerator to some of the most sophisticated components in your smartphone in the course of a generation. That's exciting to me because, again, I don't like to focus so much on the demand side about the fact there are lots of Chinese people, because if there are lots of Chinese people buying things, but they only buy crap, it doesn't help us. It's the supply side. It's the fact that there are Chinese companies which are now doing things that we could only dream about 10, 15, 20 years ago, which is so important. And if I go beyond the hardware side of things I've been talking about, we've also got some of these .com stocks or these internet stocks, which, again, perhaps in the context of quite a loose regulatory environment previously, but they're some of the most advanced companies in their field anywhere in the world. So that's pretty exciting. So it's the innovation I keep coming back to. And somewhere we've got a chart, I've seen a chart which shows patent applications in China, or R&D as a percentage of GDP. And it's not a very sophisticated chart, because basically what it shows is that 20 years ago, when China was just making simple stuff, it had no R&D, because you don't need R&D to make sports shoes, or not much. Conversely, now if you look at the number of STEM graduates, you look at the R&D expenditure as a percent of GDP, you look at the number of patent applications, China has gone from being nowhere in particular to being, if not world leading, at least a contender. So looking forward to the next 10 years, that's what I focus on. If we carry on getting that innovation, there'll be ways to make money out of it. If China gives up on innovation, which I don't think they will, then we have a totally different issue to deal with. So that's it. We've got urbanization, we've got actually some aging population, we've got growing middle class, we've got all these good things, but you've got to bring it back to the companies, because that's how we make money.
Thanks, Alex. And one last question before we end our session, and I hand it over to you to summarize. End of the day, one very important factor for re-rating of any equity market is also FII flows. So how do you see foreign investors looking at China market after this 1 year period of underperformance? Are they excited? Are they standing by? Or you've already seen some interest and flows coming in?
Fair question, very fair question. And actually the answer depends slightly by geography. So I would say that in North America, investors are happy to wait on the sidelines. They've got the world's sexiest capital market on their doorstep. They're at the epicenter of whichever Western tension there might be with China. And I think there are some sophisticated investors there who would like more exposure to A shares, for example. But there are plenty of people who are willing to sit on the sidelines. And I think that the retail client base would be part of that. At the other end of the spectrum, and Europe is, I would say, kind of in the middle, in Asia, I have a lot more conversations around, is this a good time to buy, than is this an investable asset class? I will still find Americans who say, is China investable? But in Asia, everyone accepts it's investable. The question is, do they want to put more money in? And if I just look through the flow of our products over the last 9 months, we've basically been net flat. So we haven't had inflows, or we've had inflows into some of our Greater China products, outflows from others. But net, it's been fine. So I would say that, if there's a problem with that, it's that we haven't seen capitulation yet. But equally, we haven't seen, that might be something that we would want to see to mark the bottom of any market. But there's no sense in my mind at all that our clients in this region are panicking. I want to say one other thing as well, of course, because we've been talking about mainland China for the duration of this call. The Greater China Fund has also got some Hong Kong stocks. It's also got some Taiwanese stocks in it. So part of this broader region. And that gives us a bit more ballast in terms of real estate in Hong Kong, for example, or leading regional financial franchises. So the best banks might not be in the Chinese mainland market, but you've got some very, very good insurers in Hong Kong, for example. And then, of course, we've got by far the world's leading semiconductor company in TSMC in Taiwan. So I needed to mention that before we wrap up.
Right. Thanks. Thanks, Alex. I think so. While we have many questions, but we've already answered most of the questions through the presentations and the prepared question and answers which we have done. I would just like you to sum it up, at the end of this session. If you have any couple of important points to sum up for our viewers.
Well, let's finish on the final slide, please, in the deck. So if we just jump forward one more slide. So first, whoops, we need to go back one, otherwise I can't read it. But first, you need to invest in China with experts. So that's on the left-hand side of this page. And I would say that there's no one out there which has got a better resourced team of people on the ground who are able to do this. So it's not easy. It's interesting, but it's not easy. So that's the first thing. The second thing then is that those experts are driving a best ideas portfolio of quality growth companies in Greater China. And this is for the longer run. So that's the key thing to keep reminding ourselves of. And over the longer run, on the right-hand side, you can see that's generated some really strong performance for us. Now, the last year has been difficult. It's been challenging, and I totally accept that. But this is a volatile asset class in a difficult time. What I focus on always is the longer run results, and over the longer run, we've shown that we can add value versus the benchmark, but you do need some patience for that. So if you don't have patience, then possibly this isn't the right asset class. If, on the other hand, you believe the longer term story and are willing to put part of your portfolio here, and of course, importantly, diversifying away from the bulk of your assets, which might be in India, then I still have the belief that this is a good way to approach that. So I think that's how I will summarize, Niranjan.
Right. Thanks. Thank you so much, Alex, for clearing most of our doubts. We've got very good feedback and messages from our partners and investors. So thank you so much, and thank you all the listeners and viewers. If you have missed some part of this presentation, we'll be putting the recording of this on our website. A pointed presentation and a brief note covering all these points will also be uploaded on the Greater China Fund page on our website. So do visit and check them out. And thank you so much for joining us. Thank you, Alex. Thanks, everyone.
Take care now. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.